Knowing when to sell is just as important as knowing what to buy. Many investors spend all their time searching for the next hot stock or analyzing market trends. But without a clear exit strategy, gains can vanish and losses can compound. Selling isn't giving up. It's about protecting your capital, locking in profits, and maintaining discipline. Emotions play a huge role in selling decisions. Fear can cause you to sell too early, missing out on future gains. Greed can make you hold too long, watching a profitable stock erode. Impatience, overconfidence, or even envy of other investors can cloud judgment. By planning your exit in advance, you remove these emotional pitfalls. Scenario, example 1. Imagine buying a tech stock at $50 that rises to $80. Many investors hesitate to sell, hoping for $100 or more. Fear of missing out pushes them to hold too long. A preset exit plan would have them secure profits at $80, eliminating second-guessing. Scenario, example 2. Conversely, a stock you bought at $50 drops to $45. Panic sets in, and some sell immediately, locking in losses unnecessarily. If you had predefined stop-loss rules or target prices, you could have reacted logically instead of emotionally. A well-defined exit strategy begins with understanding your investment goals and risk tolerance. Ask yourself, why am I investing in this stock? What return will satisfy my goal? How much loss am I willing to tolerate? Answering these questions allows you to set rules for selling before emotions interfere. It also helps to think in scenarios, not just numbers. What if the stock skyrockets? What if it drops sharply? What if it stagnates? Scenario analysis. If a stock jumps 60% in a few months, a target price ensures you capture some gains without being greedy. But if a stock drops 15%, a stop loss prevents deeper losses. If a stock hasn't moved after your planned holding period, a time-based exit helps you reevaluate. Discipline and planning also counter common behavioral biases. Loss aversion. We fear losses more than we value gains, which can make us hold losers too long. Overconfidence. We assume we can predict future market movements, often leading to missed exit opportunities. Recency bias. We focus on recent trends and ignore long-term fundamentals, causing reactive selling. Professional investors use structured exit strategies for a reason. Portfolio managers define rules for each investment based on valuation, growth potential, or risk limits. They know that even the best stock picks can underperform without a clear exit. Analogy. Think of investing as a journey. You plan the route, anticipate stops, and prepare for detours. Selling is a stop on that journey, planned, deliberate, and strategic in the way. It's not a sign of failure, but a way to protect progress and prepare for the next opportunity. Reinforcing key points. Selling protects capital. Selling locks in profits. Selling requires discipline, not emotion. Planning reduces stress and improves decision-making. Back. Extended example. Suppose you hold multiple stocks in a diversified portfolio. Without exit rules, you might sell your winners too early, missing out on growth. Hold losers too long, compounding losses emphatically. React emotionally to market volatility, undermining long-term results. With a structured exit plan, you capture profits systematically, buy seconds, minimize losses strategically, make consistent, rational decisions across all holdings. Selling without a clear strategy is one of the most common mistakes investors make. The three key exit strategies, target price, stop loss, and time-based exits, provide a structured framework that reduces emotion, protects capital, and helps secure profits. Let's explore each strategy in detail, with real-life examples, scenarios, and psychological insights. 1. Target price. Lock in profits. A target price is the level at which you decide to sell a stock to realize gains. Setting this in advance removes uncertainty and emotions. Example. You buy a stock at $50 and set a target price of $80. Once the stock hits $80, you sell a portion or all of your shares. This ensures you capture profits before market volatility can erode them. Extended scenario. Suppose the stock continues to climb past $80. You could sell half at $80 and let the remaining shares run to $100. This way, you capture gains while staying exposed to upside potential. Why it works. Target prices act as milestones. They give investors a roadmap for selling, preventing indecision, and avoiding the common trap of waiting for perfect timing that may never come. 2. Stop loss. Limit downside risk. Stop losses automatically sell a stock if it falls below a preset price. They're essential for capital preservation and preventing small losses from becoming catastrophic. Example: buy a stock at $50, set a stop loss at $45. If the stock drops to $45, it sells automatically. You avoid deeper losses, even if the market continues to fall. Extended scenario. A pharmaceutical company announces a failed trial. The stock plummets rapidly. Without a stop loss, an investor may panic and sell late, losing more. With a stop loss, the sale is automatic, removing emotion from the decisions. Psychological insight. Stop losses counteract fear, panic, and the natural tendency to wait it out. They provide structure during volatility, giving you confidence that losses are contained. 3. Time-based exit. Stick to your plan. Time-based exits involve selling after a predetermined holding period, aligning with your investment goals. Example: you invest in a renewable energy stock with a 3-year horizon. Regardless of short-term price movements, you review your position after 3 years. Why it matters. Time-based exits encourage long-term thinking and reduce impulsive reactions to short-term volatility. They also force periodic evaluation of your investments, helping you decide whether to hold, sell, or reallocate. Scenario analysis. Stock surges in year 1, partial profit-taking may be appropriate. Stock falls in year 2, review fundamentals and market trends. Stock stagnates, decide if potential still aligns with your goals. Time-based exits reinforce discipline, making sure you act strategically rather than emotionally. Combining strategies, a comprehensive framework. The most effective exit plans often combine all 3 strategies. Target prices to capture profits. Stop losses to limit losses. Time-based exits to enforce long-term disciplines. Scenario. Example: buy a stock at $50. Target price: $80, right pointing arrow, sell 50%. Stop loss: $45, right pointing arrow, automatic sale if price drops. Time horizon: 3 years, right pointing arrow, review remaining shares. This approach captures gains, limits losses, and aligns with your investment horizon. It also provides flexibility to adjust to changing market conditions. Psychological and emotional benefits. Structured exit strategies reduce stress and build confidence. Investors know exactly when and why they'll sell. They avoid reacting impulsively to market swings or news headlines. Common biases addressed. Loss aversion. Avoid holding losers too long. Recency bias. Ignore short-term trends and focus on long-term strategy. Overconfidence. Rely on structured rules rather than gut feelings. By combining strategies, you create a decision-making framework that supports rational, consistent behavior across all investments. Real-world example. Imagine a tech fund with multiple high-volatility stocks. Stock A rises sharply, right-pointing arrow, sell partial shares at target price. Stock B declines unexpectedly, right-pointing arrow, stop-loss triggers sale, limiting loss. Stock C is stable, right-pointing arrow, time-based exit ensures a review after the planned period. The portfolio grows steadily over time, with risks managed and profits captured. This is the power of a structured exit plan. Key takeaways. Target prices provide profit discipline. Stop losses protect your capital automatically. Time-based exits enforce long-term thinking. Combining strategies creates a robust exit framework. Selling becomes strategic, not emotional. Discipline and structure are central to long-term investing success. Having a clear exit plan is what separates successful investors from those who struggle. Many investors focus entirely on picking stocks, but neglect to plan for when and how to sell. Without a strategy, emotions like fear, greed, and impatience dominate decisions, leading to poor outcomes. The strategic role of exit planning. Exit planning transforms selling into a deliberate, strategic action rather than a reaction to market noise. It allows you to capture gains at the right time, limit losses when markets move against you, maintain a consistent, rational approach across your portfolio. Scenario example. Imagine a diversified portfolio. Stock A hits your target, right pointing arrow, partial profit taking secures gains. Stock B triggers a stop-loss right-pointing arrow, limits downside. Stock C reaches the planned time horizon, right-pointing arrow, evaluate fundamentals and decide next step. This structured approach ensures you avoid impulsive decisions and can redeploy, protecting capital and locking in gains. One of the most important benefits of exit planning is protecting capital. Many investors lose money not because they chose the wrong stocks, but because they held too long or sold too late. Example: investor buys a high-flying tech stock at $100. It jumps to $150. Right-pointing arrow. No exit plan, right-pointing arrow. Greed keeps them holding, right-pointing arrow. Stock drops to $120. Strategy: profit is smaller than it could have been. With an exit plan, a target price or staged selling strategy would have secured the gains systematically. Locking in profits ensures that your portfolio steadily grows over time, even if some positions eventually decline. Reducing risk and emotional stress. Market volatility can cause panic, but exit plans reduce emotional impact. Investors know what to do when a stock rises, falls, or stagnates. This clarity builds confidence and discipline. Behavioral insight. Humans naturally react emotionally to rapid gains or losses. Exit planning counteracts biases like loss aversion. Avoid holding losers too long. FOMO, fear of missing out. Prevent chasing unrealistically high prices and buys. Loss aversion, recency bias. Prevent overreacting to short-term trends. Structured exit rules act as a safety net, allowing you to act logically, not emotionally. Scenario analysis. Multiple possibilities. Let's consider multiple market scenarios for a single stock. Stock surges past target price. Partial selling captures profits while keeping exposure for additional growth. Stock drops below stop loss. Automatic sale limits losses, preserving capital for other opportunities. Stock remains flat during holding period. Time-based exit prompts a review of fundamentals. Should you hold longer, exit, or reallocate? Each scenario highlights how predefined exit strategies provide control and clarity, even in unpredictable markets. Reinforcing discipline and long-term growth. The key to long-term investing success is consistency. Regularly following your exit plan reduces mistakes, helps you grow wealth steadily, and prevents emotional swings from derailing your progress. Extended example. Imagine an investor who follows a disciplined exit framework across a 10-stock portfolio. Some stocks hit targets, right-pointing arrow, profits taken. Some trigger stop losses, right-pointing arrow, losses minimized. Some reach time-based evaluation, right-pointing arrow, strategic review. Over years, this disciplined approach produces steady portfolio growth, reduces stress, and ensures rational decision-making. Out of times. Practical tips for exit planning. Define goals up front. Know your profit targets, acceptable losses, and time horizons. Document your plan. Write down the rules for each investment to reduce impulsive decisions. Review periodically. Reassess targets, stop losses, and timelines based on changing fundamentals or market conditions. Combine strategies. Use target prices, stop losses, and time-based exits together for a robust framework. Stay disciplined. Treat your exit plan like a roadmap. Follow it consistently. Closing takeaways. Selling is not a failure. It's a strategic part of wealth building. Planning exits ensures profits are captured and losses minimized. Structured exits build confidence, reduce stress, and enforce discipline. Consistency and rational decision-making are more important than timing the market perfectly. Think of selling as part of the overall investment journey, not as a reaction to short-term noise. A clear exit plan allows you to take profits strategically, minimize losses, and grow wealth steadily. Selling becomes deliberate, disciplined, and strategic, supporting long-term investing success.